you've wiped out a whole year of upside. Boom. And that's the way ambushes occur. And the point is that we make is this is just the beginning. And instead of looking at the bounce in the S&P, focus on the sectors that still aren't headlines. Financial sector, commercial real estate. The historical record of silver's trends does not correlate to the Bloomberg Commodity Index. It correlates to gold. And I think the people who dumped silver a week ago made a big mistake. So I'll tell you what I did personally. I bought a lot of calls coming up out of that hole. Okay, a lot of calls.
In today's news recap, gold soars past $3,200 as trade war deepens, dollar loses ground. Gold blazed past the $3,200 mark on Friday as a faltering dollar and an escalating U.S.-China trade war stirred recession fears, sending investors flocking to the safety of the yellow metal. Spot gold was up 2% at $3,236.67 an ounce after hitting a record high of $3,243.82 earlier in the session. Bullion is up over 6% this week. U.S. gold futures climbed 2.4% to $3,253.20. Gold is clearly seen as the favored safe haven asset in a world upended by Trump's trade war. The U.S. dollar has depreciated and U.S. treasuries are selling off hard as faith in the U.S. as a reliable trading partner has diminished, said Nitesh Shah, commodities strategist at Wisdom Tree. China increased its tariffs on U.S. imports to 125% on Friday, raising the stakes in a confrontation between the world's two largest economies. The dollar fell against its peers, making greenback-priced bullion cheaper for overseas buyers. A combination of central bank buying, U.S. Federal Reserve rate, cut expectations, geopolitical instabilities, and a surge of investor flows into gold-backed ETFs has also supported gold's rally this year. U.S. monthly producer prices unexpectedly fell 0.4% in March, but tariffs on imports are expected to drive inflation higher in the coming months. Traders now bet that the Fed will resume cutting rates in June and see around 90 basis points worth of cuts by the end of 2025. A minor correction for gold wouldn't surprise, but the path forward is up and away as CPI and PPI gives the Fed more room to cut and will keep downward pressure on the dollar, said Tai Wong, an independent metals trader. Spot silver gained 2.7% to $32.05 an ounce, while platinum added 0.2% to $939.80. Palladium advanced 0.6% to $191.50, $913.65. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
And the little babies on a leash, or little puppies on a leash, would be silver and the gold and silver miners. And if you go through history, you'll see there are times when they vastly outperform gold on the upside, and then there's times when they vastly underperform. And over the last 2 years approximately, they've underperformed and gotten, well, now the miners have broken out. They've broken out versus gold recently in the last month or so, meaning their relative performance, technical behavior of miners versus gold. You know, like divide the price of GDX into the price of an ounce of gold and plot it, okay? That is broken out and telling us, in fact, before the recent surge in net price in the miners, it told us miners are now an outperformer to the mama, okay? Silver got punished very badly 2 weeks ago, if you remember Thursday and Friday, silver dropped from a high that week at 35 to a low on Monday's opening at 27.50. Wow, I'm talking futures now. Whoa. Well, they close out this week at 32. Okay, so a lot of people assumed that silver has industrial aspects, and therefore, if we're going into recession, you sell all commodities, including silver, because it's got industrial aspects. The historical record of silver's trends does not correlate to the Bloomberg Commodity Index. It correlates to gold. And I think the people who shorted, dumped silver a week ago, made a big mistake. So I'll tell you what I did personally. I bought a lot of calls coming up out of that hole. Okay, a lot of calls.
That's interesting. Sorry to interrupt you. I bought some calls in silver yesterday.
Okay.
So, yeah.
Not bad. You probably bought it when silver was 31 bucks or something.
Yeah, and they're actually doing quite well, but they're September options that they expire in August, so there's plenty of time.
I think so, because if I've been expecting an acceleration phase in silver and the gold and silver miners and gold to occur. And the thing that was needed was to break the stock market. Well, we've started that process in a way that people have been smacked in the face. They realize something's happening here. Okay. And they're moving into gold and related. And it's the next phase down in stocks, I think, will drive us off the page in gold and silver and the miners. We predicted before this drop occurred in the S&P that while it was very negative, going down for a long time, expect a bounce point. And we specified a number for the S&P, 4,800. Well, again, we're talking about a market that topped just above 6,000. Okay. It hit 4,830 this week and exploded the next day, which is what we expected to see, a bounce at that level. NASDAQ 100, we predicted, again, this is something that was like 22,000 or something, the peak. It's 16,500. It bottomed this week at 16,500. I say bottomed, I mean bounced. And you can circle those lows on a price chart now. And the public, what they did is, if you go back to 2022 high in the S&P, it was 4,800. So people drew with a crayon, we make fun of them, and a ruler across that high, said, I'm going to buy it at 4,800. Okay. It worked. It should have worked, because there were some other reasons for that to work as well. But it's temporary. And for the NASDAQ, if you went back to its peak, which was in November of 2021, its peak area was 16,700. We went down to 16,500 and boom, exploded. You go back through those lows going forward, whether it's a week from now, 2 days from now, a month from now, that's when the public is going to say, oh, hell, it's for real. A lot of them are still debating. You know, they think, oh, if the tariff thing will end, it's all over. Well, Ray Dalio said, and he's right, this is much bigger than just the tariffs. That's an excuse. That's when you'll see acceleration in monetary metals.
In today's news recap, gold hits a new record as investors seek safe havens. Gold touched a new record on Thursday as the U.S. dollar declined and investors focused on the escalating trade war between the U.S. and China. Gold futures surged as much as 3% to touch an intraday high of $3,193 per ounce before paring gains as traders digested the latest development related to President Trump's tariff policy. On Thursday, the White House confirmed the recently increased tariffs on Chinese goods now stand at 145%, not 125% as previously stated. This follows Trump's announcement on Wednesday of a temporary reciprocal tariff pause on most U.S. trading partners while upping the levies on China. Firstly, policy continues to be made in an utterly random and incoherent nature, wrote Michael Brown, senior research strategist at Pepperstone, in a note early on Thursday morning. This continued incoherence, I guess, should also help keep the bull case for gold relatively solid, too. Gold futures are up more than 20% year to date, making numerous all-time highs along the way amid trade uncertainty and increased expectations that the Federal Reserve will step in with rate cuts this year. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
The Fed started cutting rates for the first time in a while. They've been raising rates after 2003, I think it was. But in 2005, they quit. But the market was topping in 2006 and 7, peaked in October. Well, they cut rates for the first time in September, 1 month before the high. And the market still went up, made a new high, S&P. Already the banks were headed down, by the way. We'll talk about that in a minute. And it wasn't until, now this is Bernanke now, he was hit. They cut rates all the way down, and a year after the high, in October of 2008, stock market had what you would call a crash month, 30% in October 2008. But in September, the month before that crash, Lehman Brothers went under. And the Fed had been doing nothing but cutting rates, thinking that would help, and it wasn't helping. Okay. Finally, Bernanke, after the blood was in the streets in November 2008, did QEs. Took the Japanese playbook and said, we're with you. And they did QE for a couple years, quantitative easing. This time around, actually went in and bought ETFs. They bought corporate debt ETFs, put them on their balance sheet. Now, what you're saying is that they've continued to let it drain. Well, are they going to be late again, as Bernanke was? And remember, Bernanke told the public, he says, mortgage situation is totally, quote, under control. So nobody should have gotten out of the stock market back in 2007 and 8, right? Okay. And he responded late. But the question is, does Powell remember that? Too late doesn't do any good. Because in November of 2008, after the October crash in October, stock market went down sharply again and kept going down till March. 31% more down after the October collapse. What happened in the November of 2008, after that October stock market sell-off, when stocks kept going down, gold exploded in November, and by early the next year was back at its highs. They QE took gold off the page and continued up to 2011. What's the Fed going to do now? Are they going to twiddle their fingers and say, well, the data looks good? You know, because it's old data. And there was even a woman reporter who asked Powell in that meeting on Friday, you know, when he had a press conference. He said, well, the data economy looks strong, et cetera, et cetera. And this woman, smarter than he is, apparently, said, but don't you know those data points don't go negative until the stock market goes down? They're late in the game. So she kicked him in the shin. Maybe she should be head of the Fed. I don't know. So hopefully they're late again, because if they are, then they're going to have a bigger problem than you know, even Bernanke had.
Yeah, and talking about the Fed, Michael, I saw there's I think she's the head of the Boston Fed.
Okay, yeah.
Came out this afternoon.
Mm-hmm.
Federal Reserve absolutely ready to help stabilize market if needed, top officials. The other thing I saw is here from Jamie Dimon. Dimon predicts Treasury market kerfuffle where Fed steps in. JP Morgan. So it looks like people are getting concerned.
Her phrase of various tools. Okay, not cutting rates. She's meaning what I'm talking about. They're going to start printing. They're going to start buying assets. And they've waited long enough. And even their friends, academic friends of the Fed and political friends of the concept of the Fed. What did she say? They're in various tools. There you go. She means not just rate cuts. Okay. So they're telling us ahead of time that they're ready to do some crazy stuff. So that balance sheet's going back up, and gold doesn't wait for the facts. It knows it ahead of time. And that means they're going to further degrade the speed of the degradation of the money unit by increasing the money supply. And they're going to come in and buy stuff. The problem is it don't work. Okay, not in this kind of bubble. We have the biggest bubble in history. The liquidity that they create will go somewhere. But historically, it never goes into the breaking bubble. It goes into something like T-bonds, and it always goes into gold and gold related.
What do you think of Michael's take? Do you agree with his call that a breakout in precious metals is not just likely, but inevitable? Is the S&P living on borrowed time? Let me know what you think in the comments below. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.